Thank you so much for having me. I know that I have invested in about 15 passive deals. And the minute they know that you're a passive investor, I get bombarded with deals on a daily basis. And so I was trying to start putting some criteria together because while most of the deals have done well, there's always that one or two deals that are just not performing. And, it's been a year since I gave them my money and I've had no distribution, et cetera, kind of scenarios. So I started defining a criteria and I thought this could definitely help others ask the right questions and figure out what their risk tolerance is before they invest in a deal. And I have two example deals from a year ago. So some of that is not as valid post-COVID, and we'll talk about that. And so now I actually know how those deals are performing. So I'll tell you at the very end after you go through and decide which deal you like a little bit better. So I'm going to try to share screen. And host has disabled participant screen sharing. So if I can share it, that'll be cool. Okay, now I think I said share for everything. So hopefully, can you see everything? Are you?
Yeah, we could.
Awesome. Yep. So this is my background. I'll start with a basic intro slide. My background, I've got a couple of decades of investment experience and I paid a lot of money in taxes, which is what led me to multifamily 2 years ago, about 2.5 years ago. And I've done a lot of passive deals. And I want to, of course, point out that I'm not a financial advisor, CPA, legal advisor, none of the above. It's just my opinions, and I'm not shy to express them. So keep that in mind, that you could have a completely opposite opinion and you could be very much right. We could both be right, or I could be completely wrong as well. But the big thing I want to emphasize is only invest with people you know, like, and trust in a deal for which you have the sophistication to understand the risks and the finances to handle the risk. And by that, I mean, I always like people to have 6 months of living expenses before they invest in a deal. And yes, it is always possible with any kind of investment that you could lose 100% of your investments. It's highly unlikely for that to happen in multifamily, but it's definitely a possibility. I think we all know what's a syndication, so I'm going to zip through this one. LP is basically someone who contributes money to the deal and has no say in how that is run. So we're going to pretend like we're all LPs or limited partners who are looking to invest passively in a deal. And we're being presented with two different deals from two sponsorship teams. And we're going to make a decision on how to invest. And so passive investing is, again, mailbox money where you don't have to do anything other than initially vetting the sponsor and the deal, and the money comes to you hopefully periodically as deposits. And I think we all know about multifamily versus single family, so I'm skipping that. This is just your financial goals and your risk tolerance. Always keep this in mind when you evaluate an investment. What is most important to you? Do you need a regular cash flow for the next 12, 24, 36 months, etc.? Or are you okay waiting so that at the end you might get a bigger appreciation on that deal? That's a very important thing to keep in mind, as a deal more based on cash flow versus appreciation. Another one is just, other metrics and whether or not depreciation is important to you. Many of you might already be realtors or qualified real estate professionals. So definitely decide if depreciation is important enough that, like a deal closing now versus in January, the December deal might be more important to you. Also, the risk tolerance is always important. It's always a longer holding period with real estate. You don't usually see your money back for anywhere from 3 to 5 years typically. So make sure you kind of like to get the best risk-adjusted returns for your money, like a Sharpe ratio when it comes to the stock market. But in real estate, you want to reduce your risk by picking the deals with established sponsors in good locations. Vetting a deal sponsor and a team is very important. And the part about the sponsorship team that I'm going to really emphasize is, remember that you want them all to have skin in the game. So if you are going to invest a minimum of, say, 50K in a deal, you want to make sure those sponsors also have at least 50K in the deal. And a lot of them don't. Many of them do. So it's important for me that the sponsor has at least as much financial risk as me. When I invest as an LP, the GP also needs to have 50K in the deal after closing. And why is that important? Because a lot of them have a large acquisition fee. So after they take their acquisition fee, do they have even a penny left in the deal? Or is it purely a matter of not having any money in the deal and making money on the deal, regardless of whether or not the LPs get any money? That's important to me. That's not as important to some others, but I just want to point that out as a question to ask when you review a deal is, what is the acquisition fee? Do sponsors have at least the minimum left in the deal after acquisition fees have been taken? Again, what's the most important metric to you? Do you want preferred returns? What are preferred returns? This is where a passive gets money first before anyone else gets money. And so some deals you might see class A, class B, etc., different levels of investors. And the thing about a preferred return is that sometimes when they give you a 7 or 8% preferred return, you don't get to participate in the equity split at the end. All you get is that preferred return for those 5 years. You don't get to take that, 80, 20, 70, 30, whatever that split is. You don't get to participate in that. So that's good to know, and that's good to ask when you're presented with a deal is once you get a preferred return, is that all you get, or do you get to take part in both? Good. This is my note to myself, so I don't keep going because the next slide has some other stuff. So now I'm going to switch to another screen, which has 2 webinars from 2 deals. And I'm going to try to go to the first slide. Hopefully I'll be successful. Okay. So this is, of course, I've hidden the name of the property so no one can guess. But both the examples I have are in the Dallas area. This is one apartment that's actually located in Fort Worth that I know all about. So they always start with this disclaimer to say that, yeah, we're trying to be as accurate as we can in representing this info, but you know what? The PPM is the one that has the real stuff in there. So be sure to read it no matter what we say in the webinar. That's what they're basically trying to say with this disclaimer. So make sure you read that PPM when it comes to you. It might be worth paying a lawyer to read that for you, only because sometimes really the lawyer who wrote that PPM works for the syndication team and they write it in favor of the syndicators. So that's a good thing to read. And then this is their webinar, and they talked about why somebody would invest in multifamily. And I'm going to go to the executive summary of this deal 1. I'm going to call this property ABC. So they are promising a great 1.7x multiplier, which means if you invest 100K today, you're going to get at least 170K in whatever the end of the term. So I'll let everyone stare at this slide for a minute and see what they like or dislike about this opportunity, assuming it's an excellent location with an excellent sponsorship team. So they're buying it at a 5.6% cap rate with a 6.5% reversion cap rate. 80-20 is a pretty typical GPLP split. They have a $350,000 budget for rehab for 105 units, which amounts to less than $3K per door. Hint, hint. They're saying you'll get 8% average cash on cash. We all know how average is calculated, right? That could mean 1 or 2% the first year and like 15% or 20% at the end. So that the average is 8%. So remember, you might get no money the first year. 13% IRR is pretty typical. Value add opportunity, community impact, conservative underwriting.
I don't believe it.
Okay. Who's buying into this deal yet so far?
Not at all.
Nobody's buying this.
It's a 1964 property.
Yeah, the Reno budget is too little.
Okay. What else? Is everything else reasonable?
And the cap rate, reversion cap, that's not right, because the cap rate alone is they're starting from very high already. So I mean higher, sort of higher. So it's not really.
What should it be, the reversion cap, if it's not 6.5? I mean, this is in Fort Worth, so I know that. And properties today are selling in the 5.5 caps in Fort Worth. So any other comments?
It seems to me if they've got a 98% occupancy rate, they're
Mhm.
not going to be able to rehab those very quickly.
Yeah.
I mean,
Yeah.
especially if, you know, there's no plans for them moving out.
Yeah.
Yeah. Plus, the budget, if you look at it, it's as Sandhya was saying, it's only 3,000 per unit average, and it's 105 units, and it's 1964 built. It's almost impossible to have
And
that.
unless their business plan is to only renovate,
A
15
small
units and then
percentage.
prove the concept and sell it to the next buyer. But there's not enough detail to really know if they're
Okay.
renovating all the units. Then
Right.
3,000 a unit on a C-class 60s build is impossible for sure.
Right.
Depends on how many are in. So then the value add opportunities are that in place rents can be pushed, adding carports, and then water savings from green programs.
So if the reno, most of the reno is adding the carports.
And then some premium unit upgrades and staff expense savings and laundry upgrades. That seems to be their plan.
So it's not the actual units themselves.
Yeah, not much is going into other than it says premium unit upgrades. We need to see how much that is. Okay. I had to skip a couple of slides that we're just talking about the market stuff, which I already said it's Fort Worth, it's a good market. So this is what the asset looks like on the exterior. They always have some nice pictures. At first glance, it seems fine. I'm not seeing anything particularly disturbing. So this is some of the details about it. I like to see, I'm not sure what that roof is. Does anybody know?
Flat.
Mansard roof. I'm just thinking, look at
Mansard roof is
Mansard.
where the shingles hang over on the side.
See, I knew somebody would know that.
Yeah, they're not
Wow.
very desirable.
Okay,
to
because
own. They're kind of a pain to maintain because the shingles always try to fall off because shingles are not supposed to. They're not meant to hang sideways. They're meant to be more flat. My terminology is not there, but you get the point. I know they're not a good thing to see in an investment.
Okay, that's good to know. It's brick exterior, concrete, and owner is paying a lot of the bills, it looks like, water, electricity, and gas.
For 105 units, oh my God, that's a lot.
It's all bills paid, I guess. 14 buildings, 2 stories, ample parking.
What did it say about the rent being where the rent was, according to market?
I don't think we've seen a slide on that, right?
I thought it mentioned it back on the other slide we were looking at.
Okay, I'm gonna look. I don't remember. This is the slide we
No
looked at.
mention, yeah.
I just thought this was like more of a high-level overview slide.
Mm.
Is this one you invested in?
Okay, yeah, it's not on there. I'm sorry.
We're not going to say anything right now. I'm just going to tell you that I know what happened to this property and the other property, but I'm going to wait till the end just to see what the team thinks of these 2 deals. Both these deals were in 2019.
Okay.
So this is an aerial view of the property, etc. So you can see from the pictures, and they have some interior finish. They have the unit mix, 1, 2, and 3 bedroom.
Do you know how long the current owner has owned the property? Do we know that?
I know it's over 2 years. I don't know if it's too much longer than that. It wasn't positioned as a long-time single owner thing.
Okay.
So to have a huge upside. I know that. I know it was another flip by another, multifamily owner who buys it, keeps it less than 5 years and then sells it again kind of deal. I know that.
They've probably come in and made some modifications or upgrades on some of the property, you would hope.
Yeah, I'm sure they did some and then left some for the next buyer,
Right.
kind of scenario. So again, they had a unit mix picture and some amenities which look nice, some pool and playground and laundry area, etc. And the location is a good location. So we'll all agree to that both of them have an excellent location. Of course, this is again market data, units, etc. We'll say that both deals are located around there. So in that sense, market and location is just as good for both deals. One of the things they're highlighting here is the average household income of 86K. You always want to ask for median household income, because if Warren Buffett moves in there and he's 10 million, 100 million, whatever, that pretty much skews your average. With every other house could be $10,000 median household income, right? So you'd always want to ask for median numbers rather than average. Okay, where am I here? This is the average occupancy in the high 90s for all the comp properties nearby. So they're trying to say this location is popular, you shouldn't have a problem with occupancy. So now let's get into the underwriting numbers. Okay, this is 9.2 million. They were ending up paying 9.5 for it, above Whisper, for 105 doors at a cost of $90K per door. For Fort Worth, that's a pretty reasonable number. They're saying that the passives might get 84% overall returns with a 9% cash flow. It's a little bit different from what I saw on the other slide, but okay. The overall rent increase is 9%. I don't know if you can see that in the slide.
Where
you
is
scroll
that
up?
Sandhya? I don't think I'm following now. Overall
Okay.
increase?
So we have unit mix, current, pro forma. So we have these blue
To
cells
the right. Okay.
with the right column being percentage rent increase. So the overall number there is 9%.
That is super. I've never seen that number before, ever.
Really?
Oh, God.
Okay, 9% is pretty typical,
That
but
is,
not in the first year.
yeah.
But overall, 9% rent increase in pro forma is pretty typical that I have seen. What about others? Like when you underwrite your deals, do you see a 9% rent increase?
I've never seen a 9% rate
I've never
increase.
seen.
How much do you normally see?
Average is 3% for me. I'd like to see 3%. That's more sustainable.
Year on year, right? This is for the life. Okay. Closing costs, 4.5%. That makes me suspicious that there's some acquisition fee built in there. Their total rehab, in this case, seems to be 200 plus 200. Okay, what other stuff? Do you understand the spreadsheet? Is there anything in the spreadsheet you want me to explain in more detail? You have 3 years of interest only, 4.25% interest rate. Okay, I'm gonna go to the next one because we're already almost at 8:30. So I wanna look at 2 deals. So, okay, this is the 5-year pro forma. And here you can see the annual rent increase is the very top. It looks like it's a 3% and 2 and 2. So it's a 322. So the actuals of trailing 12 and trailing 3, T12 and T3 are your first 2 columns. And then it goes on to year 1 and beyond. So I'll let some of these numbers sink in, and then you can start questioning some of the numbers. So one number I always look at is the economic vacancy. Can you see me moving the cursor?
Yeah, so where it's 93% vacancy rate right now, or 98, I think it was. So
That's
they're saying
physical.
now it's going to go down to 88? No,
So that's physical, okay? So physical occupancy and vacancy. This is economic vacancy. So this
okay.
is the collections and bad debt and all of
Right.
that, concessions, etc. So economic vacancy in their T12 seems to be around 12 to 11.5%. And this team is projecting it to be 10% throughout and down to even 9%. So they have a lot of confidence in their ability to operate this property with very, very efficient numbers. Have you seen that typically, folks? 10% and then 9%? right from the beginning?
No.
No, my main concern here is
No.
gross potential rent year one. They're
Yeah.
basically assuming the day they take over the property, they've achieved all their rent increases the very next day.
Yep,
Yep.
very aggressive.
I guess all of their residents moved out and they bumped the rents and got them pre-leased and leased up the very next day after they acquired the property is what it
Which
looks
is
like to me.
totally unbelievable.
Yeah. So rent bumps are unrealistic. Economic vacancy is not conservative. Replacement reserves seem fine. Of course, their DSCR is going to be fine if they are able to increase the rents this much.
Mhm.
So that's over here. Their reversion cap 6.5, and a cost of sale seems to be a little on the low side. I like to see it closer to 300K.
Mhm.
So far, this doesn't sound like a deal we like very much, does it?
No, although,
Okay.
A lot of questions.
Yeah.
yeah.
So now they're saying the exit cap, they have assumed is 6.5, but if it goes to 5.5, you get to make even more money. That's the sensitivity of the exit cap. 4.5% closing costs includes acquisition fee and all the other costs. So they haven't come right out and said it, but I believe there's at least a 1% acquisition fee there.
Mhm.
PM fee of 3% is typical. 2% asset management fee is typical. Is there any number here that jumps as unreasonable to you on this page? Average cash on cash, 8%, meaning it could be 0 the first year or 1 or 2% the first year.
Mhm.
Always keep that in mind.
Yeah.
So they're saying you're going to get year 1, 6,000, so 6%, and then, from year 2, it's going to be more.
Which is not a reality.
It seems a little aggressive to
A
me,
little aggressive.
especially in today's COVID times.
Mhm.
So now they're telling you, go ahead and invest with us,
Mhm.
right? And Q&A. So this is their webinar.
Mhm.
So let's go on to example deck 2, which I'm going to go to the very beginning. So this is what the property looks like. So we're going to call this property XYZ. They also have the usual disclaimer. And this is a summary. So they call it cash flowing, 11% cash on cash, and 70% 5-year total return. It's also a 60s property with a high occupancy, 6.75 million purchase price, LPGP split, a little bit more in favor of the LP. So in the investment overview, they're going to rehab 54 units to achieve rent increases, and they're going to switch the property to a full all bills paid. And they're going to implement some conservation programs. So I'm going to go to the next one, unless anyone has any questions on this slide. We assume everybody has a good location. So we'll assume both locations are great and both sponsorship teams are equally competent. Okay, so this is again more on the location, low unemployment, great population. Perfect location, close to a school, etc. All kinds of economic development happening there in this happy town in Texas, manufacturing, school, etc. Things happening. So some people ask, if a lot of new homes are going to be built here, does it affect your apartments? And I don't really think it does. I just think more population is a good sign. I mean, the customers have to be able to afford a home to move out of apartments. So here we go. This is the asset. 86 units built in the 60s, high occupancy, individual HVAC. You always want to look for copper wiring. I'm looking at this and I'm seeing flat roof. So you definitely want to keep that in mind. Flat roof can have all kinds of issues with leaks, etc., things that don't get it. Any comments on that? Like Candace or anyone else with construction background?
I think it's interesting they've got solar screens in.
Yeah. In Texas especially, we want to put those because one, they don't show the ugly blinds, and two, in the summer when it's super hot, it really helps. So this
Going
is
back to the roof question. I'm not a fan of flat roofs or mansard roofs. So if
okay.
I were buying it like with my own money, like for my own investing purposes, I try to avoid those.
Okay, so both are bad in terms of roofs. Okay. 2 strikes there. Okay. So both are equally bad. It looks like this has different configurations of units. 2, 1.5, 2, 1, and then 1, 1. And it looks like due diligence has been performed by the Omni Group, and everything looks great. No problems. And this is their business plan. Upgrade 54 units. So there's already, it's a concept that's been proven. There's 27 units that have already been upgraded with similar finish and getting a $100 rent bump. So this is their upgrade package. They're going to do water conservation and LED conservation. And yes, cost seg that everybody does.
I have a question about the 54 units.
Mhm.
I noticed on the very first slide, they referenced 54 units being upgraded, which came out to like 8,000 a unit. But then I think it was the last slide you were on, it mentioned 54 units already having LVP flooring. I could go back one more.
Yeah, 55 units have new LVP flooring. So it sounds like their
Yeah, right here.
LVP flooring has already been installed in 54 of the units. So maybe they're off it by a unit count of 1. So their upgrade, okay, business plan. So they're not doing the flooring in here. They're doing the paint, fixtures, counters, lighting package, and appliances in their upgrade plan.
So they have plenty of CapEx here then, because they have $8,000 a unit, and flooring's usually about 2,000 of that. So that I feel like that's plenty of CapEx. Right?
Okay. So where did you see the CapEx? I missed that.
The very first slide, it said 432,000 divided by 54.
Oh.
Rehab budget right there under asset overview.
Okay. Yeah. So rehab is okay. So units is one of them. I that's a good point. Did everyone catch that? Rehab budget is 432K, and of that, if this is all they're going to do, they wouldn't need 8K per unit to do it on 50 units. So they probably have some other plans, which is install some grilling station, pergola, private fenced-in yards, and a new office. So bonus 2-bed, 1.5-bath unit, relocate the office, allow us to rent out the 1 unit that is currently being used as the office. So they're going to get 1 full unit's rent by doing that. Switch property to all bills paid. That I always question that. What do you think? Switching a property to all bills paid instead of out of all bills paid.
Never heard of that either.
It depends on what the comps are doing, and it depends on what total rent charges that area can sustain. At the end of the day, whether it's rent plus utilities or all in the rent, it's still a total charge per unit that the market can bear.
Yeah. Good point.
Yeah.
So this is their team. They're telling you who they're using for various things. So we'll skip that. Rehab details. So this is what adds up to the 432K. So the unit upgrades itself is about close to 250K. And so the other money is being spent on LED, water, new office, grill, deferred maintenance, etc.
Nice plan.
Was there a question?
No, I just mentioned very nice plan if it's implemented.
Yeah,
okay.
It's laid out nice.
This is awesome. Okay.
Well, I like that this still actually breaks down their rehab budget Where in
Yes.
the other deal, they just blanketed with one number, didn't tell us where the money was going.
Yeah.
I have a
I'm
question.
trying not to have any bias here as I talk about the two deals and indicate my familiarity with both deals, but I
No,
know a
take
lot.
it this one didn't do well. Are we all
No,
going
I'm going to talk about both the deals in a little bit.
Wait. Can we
Yeah.
go back to the previous slide? I have a question. So
Yeah.
on this slide, it says double French doors and fenced-in yards, 28 units. And then on the picture, it says new yards concept for 48 units. So where is that included in this budget? Because it looks like the budget only includes 28 units, unless I'm reading it wrong.
Yeah, you're reading it right. It looks like they're only going to do it to a certain number of them.
Yeah. They're not going to do it to all of it. It sounds
Well, and then right above that, it says 20 additional fenced in backyards at $30 per unit.
Mm-hmm.
Oh, additional upside potential not factored into underwriting. Okay, got it. Because that it's 28 in the budget, but the additional 20 is not factored. Okay.
Right.
Mm-hmm.
Mm-hmm.
Okay. Thank you.
So this is numbers. Can you see this or do I have to zoom in a little more?
We can see
Just
it.
zoom in a little,
Or I
please.
can.
There you
Thanks.
go.
That's better. Yeah. Thank you.
Okay. $6.75 million.
Where's your cursor at? I'm trying to follow, but
Here,
oh, okay, yeah, I got it.
that's the purchase price.
Mm-hmm, mm-hmm.
Their closing cost 3.3%, 3 years of IO. We have all these units and they have said how a 20% rent bump is deceiving because it includes converting the property to all bills paid.
Now you can use the same button.
And there's 21 additional units that can be fenced in for a $30 per unit premium. %11 average cash flow and 70% overall return. That's the highlighted portion here. Any comments on this?
I would think that the rent bump would be deceiving because of the fluctuation of utilities.
Yeah. That's a little harder to estimate. But
Yeah.
this is the more detailed pro forma.
Mm-hmm.
And over here, it's a 7.4% reversion cap. I always like to look for that. And then the second big one is the rent bumps. So here they're showing 3% and 2%. That's your top row. And an increase of annual expenses and a decrease of other income because they were going into all bills paid.
But what is the increase in income on the line two? Annual is that for the, I guess that's for the premiums that they're going to charge for the fenced in property?
Yeah. Any other sources of other income, whether that's pet income, that's reserved parking, some of the other things they had listed. Yeah, and
Right.
also the private fences, etc. That would all contribute to that other income. So 15.9% economic vacancy. I like to see that. The first year when you take over a property,
Yeah, that's more realistic.
yeah, this is more realistic.
Yeah.
11% and then down to 10%, which of course, now that we're in the COVID era, that could be greater than that.
Yeah.
But that's true for both properties. So between the two, I still think this one's more conservative than the first one.
Yeah.
I see your note about tax increases. You know Texas a lot better than I do, but is that conservative enough? I feel like taxes
Yeah.
could be hiked year one, right?
Yeah.
Yeah.
Yeah,
That's
I
a very
think taxes in both cases, usually what we tend to do is we project it to be like 100% by year 3, and then we stagger it, and then we try to get an estimate from a tax protest company that most of us use here. And that's how we write the underwriting for taxes, especially depending on the county. So
the tax
remind me, I'll tell you the actuals for both of these properties on taxes.
Cool.
Trying not to spill all the beans and let people decide for themselves based on what they're seeing, what questions to ask. Okay, so projected investor returns, 70% overall in 5 years, 14% annualized, average cash on cash of 11%, which means you could be 1 or 2% the first year and a whole lot at the end when they sell it. No acquisition fees, I always like that. 2% asset management, pretty typical. And then 86-14 split with no other fees involved in disposition. Always look out for these fees. Whether it's acquisition fee, some people have a refinancing fee when, in the second year or third year, they'll do a cash out refi, return like a percentage of your capital back. They'll charge a fee for that. They'll charge a fee when they close the property, exit, disposition fee. So just watch for fees.
But Sandhya, isn't that how most of these syndicators make money anyways? That's how they make the living.
Well, there's a lot who don't. So ask for the ones who charge the least fees and who make money by working hard, improving the property and making money at the end when the property sells.
Okay.
Because remember, you also get paid monthly. Like if you're the asset manager, right, you get a monthly money as well. So if you have enough properties that you're running, that should cover it. And yeah, so I'm not in favor anyway of fee structure. And I know probably 50 syndicators who generally charge a very low fee for these, not zero acquisition fee, but I'm okay up to 1%. And certainly if you had a deal that you got off market and you have to pay that brokerage fee, that's fine. That makes sense. But not, 2% acquisition fee on a $50 million deal, that's $1 million. And going directly to sponsors, I mean, I'm not desperate for a deal like that. I can find deals down the street from me run by people I know who don't charge acquisition fees, So that's sort of how I work. I like to reward somebody at the end. That was good music, whoever got a call. Anyway, so annualized cash on cash projected returns look like this. I want to leave some time for questions. I'm going to skip through this. So they're trying to say that at a 7.4% reversion cap, you get 70% return, but you could easily get way more than that, like double at even a 6.5 reversion cap. So that's definitely good to know that they are conservative in their numbers. They're talking about their financing and the type of loan they're taking. It's a step down prepayment penalty. So if they plan to exit in 5 years, this would be about where they're at.
Can you remind me on the first deal, can you remind me real quick, how many years of interest only was the first deal?
I believe it was also 3 years.
Also 3. And was there step down or yield maintenance on the first deal?
Don't know if they explained it. Three years.
Okay.
They did not talk about the prepayment penalty. This is the first deal.
Okay, thank you. I was just trying to compare the cash on cash returns because I know sometimes extra years of interest only can make those cash on cash return numbers look better than.
Yeah.
Yes, for sure. So both these had 3 years of IO. So yeah, but then you have less equity in the deal because of that. Okay. They're getting 80% LTV. That's great. And the sponsorship team is giving money back. Okay, wonderful. And these are the next steps. So between the two deals, what do you like? And why?
On a high level,
Yeah.
the second one looks a lot more something that I will go back and analyze in a deeper level.
Okay.
I
Any
feel
other-
like this is probably a trick question,
I
but I like Deal 2 better just because the level of detail they provided was more. I like seeing the detail of the
Mhm.
rehab breakdown. I feel like they were more conservative with their rehab budget
Mhm.
and more conservative with their vacancy assumptions year 1 and 2.
Okay.
So overall, I feel better about Deal 2, but I wouldn't invest just based on what I just saw. I would have to obviously dig in deeper.
But it's worth asking more questions, right? Between the two deals, if I had to initially choose, I'd be like, okay, I have a lot more interest in deal 2 than deal 1. So I'm going to ask, here are my questions to clarify to see if, it checks all my boxes.
Mhm.
So if we're going to compare, right, you always want to look at sponsorship, team, and location. So let's say both check. Job growth, economic indicators, rent growth justified. That's the next question. Do you think the rent numbers are justified in the two deals?
Not in the COVID era.
Okay.
And I think that the one that is switching over to the owner by paying the utilities,
Mm-hmm.
that is a concern of mine because of that expense can be quite high.
Okay. That's a good point. What about other income?
Yeah, I forgot
We
the.
didn't see that on the second deal.
I think they just, it was in one of the spreadsheets. I can show
Okay.
it. All their spreadsheets usually have
Okay,
the numbers.
I just missed it.
So over here, other income
Yeah.
is the second one on the
Right.
top. And they
Right.
have it as a 322. This is the second deal. Which one is this? This is the first deal. So this should also have it. This is more like a 222. So very similar analyzers in both spreadsheets for other income. Except property B, which is written more conservatively, is switching to all bills paid. And property A is not, or it already is all bills paid rather than being switched. I think that's what I remember. Yes. All bills paid, I believe. Yeah. Do you remember reading that?
Yeah, I remember that. It was owner pays for everything.
Yeah, owner pays for everything.
Yeah.
So it's also all bills paid. So certain markets seem to like it.
Can I just see the NOIs again?
NOI. That would be this row. So this would be it. This is for the first deal. It's a little more aggressive in its underwriting.
And what's the purchase price of this one?
This one was 9.5.
Okay.
9.5 with somewhere around a 700K and up NOI. And this one is 6.75 with NOI, hey, also in 560, 588, etc. Is that good?
I'd vote no on both of them.
Okay. Why would you vote no on the first one?
They're too aggressive in
Okay.
what they think they can bring in year
And then
year one and
there's
two.
so many. Yeah, there's so
Okay.
many factors that triggers questions for me.
Good.
The
And
rent
their the low
is-
rental budget.
Mhm.
Okay. And then the reasons for saying no to the second deal, Kathy?
Well, again, I think that they're just counting on too much of a other income and rental bump.
Because of COVID?
Yeah.
Okay.
But this is in 97, isn't it? It's pre-COVID?
This is a year ago.
Oh, okay.
Both deals are a year ago,
All right.
2019. So they might underwrite it differently for COVID, but I would say that because of COVID, you're saying it's not a good deal, Kathy. But if it wasn't, would it otherwise be good deals? If we weren't in COVID era?
I guess, I mean, I'm like Candace. I don't like to see flat roofs or mansard siding.
Okay. So that's a
and,
no-no in both cases.
And that, for that reason, I think you need a higher, CapEx to just take care of the roofs.
Okay.
And I don't know if that's accounted for in here.
Okay. So roof is a negative
Besides, it's kind of ugly.
on both.
Just kidding.
On both, you felt it was ugly. Okay. And then, but this is an investment property. I don't know.
I know.
I mean,
kidding.
I'm not picky about looks. I'm more picky about, okay, what are the risks associated with one roof versus the other? And if I really like the sponsorship teams and they are very strong in both cases, and they pick these properties in excellent locations with all this growth, then that to me adds some weight. So if I considered both deals, I would say deal 1 is more aggressive than deal 2. And I feel like with the reversion cap, I can adjust deal 2 and compare them equally. And so like, even though one deal says a better return than the other, I think that because of the reversion cap difference, which is 6.5 for this deal versus 7 for the second deal, I actually think the second deal is going to do better.
Yeah.
So now both deals are a year into being in operation, and I know enough about both the deals. Either I'm invested in them or I know the sponsors in them. Both deals are doing fine. Deal 2 is doing better than deal 1. Neither have had to replace their roofs or had any major capex to spend on the roof. The second property that converted to all bills paid has had a direct impact to their NOI from all the conservation efforts. And their delinquency is only 2 units out of 86 who have not paid through COVID.
Wow.
The other one, the property ABC with 105 units, they did initially have some delinquency issues, but everyone is paid up as of today. They're like collecting on all the renters have paid their rent in full in property A. So what else can I say about the two? Both properties have made distributions this year to their investors, although not quite as high as the average numbers they predicted at the beginning. Both properties have increased their NOI to where they are worth, both properties are worth a lot more today than they were a year ago if they had to sell. So both actually, in terms of overall appreciation, I think they will hit their projections, if not exceed it, just because of their locations. Today, properties are selling at a 5 cap in Fort Worth. And so both these properties, 6.5 cap and 7.4 reversion cap, they're gonna make money in the next 2 to 3 years for their investors.
So are you trying to say that the number one factor to consider then would be location? Of course, for me, the number one is the syndicators.
Yep. So always your sponsorship team and then the location and all the things for the location, because if the location is good and all the economic drivers are there and you know the operators, like for example, you need to actually know who is managing the asset. Make sure you get to talk to those people and ask the experience of the asset managers. I made a mistake to where I listened to the guy with all the fluff and marketing hype last year and I invested in a deal. But once he raised the capital, he was done. He didn't know anything about asset management. So now every month I'm saying, I'm seeing your numbers decline. What are you doing about this? Have you tried this? He has no clue. So
Yeah.
finally, he connected me directly with the asset manager who's running the property. We exchanged some ideas, and he's going to try to implement some of them and go find some organizations that can help pay for the rent, etc.
Mhm.
So I'm going to stop sharing screen and just talk for a little bit. But it was very interesting how people, I fell for hype and the marketing hype of someone rather than the actuals of the property. So again, I was a newbie, and that's what happened. The deal eventually, hopefully, will get me money, but it was with my retirement fund. So that's why I say, dig through all the basics, ask a few friends, run it by people in this group, right? If someone sends you a deal, I'm sure, I know I will help. Certainly others will help. Like if you bring me a Dallas deal, I'll tell you right away if it's a good location and whether that team syndicating has got any reputation, etc. But you've got other people in this group with expertise in other locations and well established in other places, like Houston. Okay, so I was looking at a deal in Houston recently, for which I was asked to get involved with the sponsorship team, and they said, "Oh, it's not in the floodplain." Well, I called on Muriel Jackson, who is also here in this
Yeah,
call.
I'm here. Yeah.
And she helped me. I was like, hey, these people are telling me this is not in the floodplain. I don't know anything about Houston. I generally don't invest there. And I asked her, and she's like, oh no, they've had so many insurance claims in that area. These people are lying to you. Don't deal with it. So that was really good, right? She saved me. So I think that's the best part about this network, is to be able to ask people here for
Yeah.
help when you don't know, so that you don't lose your money in a deal.
Yeah, and I made the same mistake as you did, Sandhya. That's my second deal, actually. The first deal, I knew I was a newbie, and I asked, like, would you invest in that deal? And I asked several persons, and I got really good advice. And the second one, for some reason, I was just so enthusiastic about investing. I just, I asked questions, and the guys, they were really prompt answering me, and they answered my question, and it was okay, and I was still on the fence, but they were so responsive and all. And the moment they closed the deal, didn't hear from them anymore. And I was asking questions, didn't get answers, and I remember trying to corner them in events to get answers to my questions. And in the end, right now, the deal like this year really went south, and thankfully the two sponsors that were like passive sponsors, that were really like KPs and all, like they took the thing in their hands, and now the deal is going back to a good place. But it was
That's good.
yeah, but we're not yet out of the woods, but it's way better. The liens are removed, the code violations are taken care of and all. But yeah, I did the same thing, like didn't check enough, didn't check enough the property and everything. So yeah, it's you do have to be really thorough.
Yeah, you have to be very thorough before you invest that kind of money. When you think about how much homework we do just to buy an appliance in the house, we're talking tens of thousands of dollars, right? Or your next car. So we got to be careful. One thing I also ask is for references from existing passive investors. Who's invested passively with you before? What do they say about you? Can I speak to them? That's always helpful. And then show me a track record of your past deals. Like, even if it's not completed a full cycle, tell me how your deals are doing today. You have a couple of deals, show me how they've performed. How did you do in terms of your cash flow and, projections, NOI improvements, etc., distributions. That's always
that particular one, I mean, the guys, they did have a track record, but it's also the time where anybody could do well, even if they were not that good. But what I failed to do was really look at the area. And I know now to do my own due diligence on the area. Yeah, location is really key.
So please, some of the other experts, Candace, Chad, Michelle, etc., whoever else has done deals passively and actively, please add your perspective.
I think this is great. I mean, everything you're saying, you have to really separate those that are expert salesmen from those that are expert operators. And I think it's super easy for a new person to get caught up in the hype. Like you said, I made the same mistake passively investing when I first started as well. And you fall for the hype of only 2 spots left and
Yeah.
minimum of 50. But if you invest 100 or more, you get first dibs, and it's easy to okay, well, I need to throw 100 in this one so I can be involved.
Yeah.
I think it's just easy to get caught up in the hype, and you really just need to slow down and step back and underwrite the deal yourself, underwrite the area yourself, make sure that you would go out and buy this deal yourself if you were actively investing. I mean, you really have to treat your passive investments almost as active investments in the very beginning, just to make sure you know what you're investing in.
Mm-hmm.
Yeah.
Also, what I tried to do, just like what Sandhya was saying also, and I completely agree with everything that you said, Candice, but to add to what Sandhya said about calling other investors, that's so powerful. Just give yourself time to call other investors, because they will talk. If they're happy with the syndicators, they will talk. But if they're not happy, they will also equally talk.
Yep.
So it's very powerful. And also, when they put the rent increase, that's also one of the numbers that I look at. The projection would be 3% to 9%, as what you showed, right? Is that sustainable? I would call the apartments personally surrounding the comps and see if it's truly sustainable.
Yeah, I try to get a CoStar report or ask them to share it, because usually the brokers have it. So I'd say, what is CoStar projecting for that area? And then you just go to apartments.com or something and type the 3 apartments they've listed as comps. It's pretty easy to tell whether that rent bump is realistic or not.
Yeah.
Or if they're really so below market in rents.
Yeah.
So
And I was going to ask you, Sandhya, about the reversal rate. So because I wanted to ask you, what would be the ideal rate with that first and that second, if you were to look at that deal?
The more the difference, the better in the exit cap, because your projections can vary dramatically with that. So I think if I have I don't know what time this webinar ends, ladies, tell me that too. But what time?
I like to see at least 1%.
Yeah, minimum 1% difference.
And sometimes it's hard because if you buy at a good price, you can get a high rate when you buy, and then that makes it very difficult to get a deal on the paper. But 1% is healthy, and it also depends of where your deal is located. Right now, there's a deal that is going on in Katy. I can talk about it because it's a 506C. But
Katy, Texas.
Yeah, and I know their exit rate is 4 something. It's really low. Yeah.
Yeah, that's very aggressive.
But it's a great location. It's a B property with tons of amenities, and so it's justified. So it really depends, what you're looking at. I would still not be that comfortable, but that's the perfect example. They got a big rebate on the purchase price. They got a 7 million off. And so, that's where you have to really weigh in everything. So,
so I just did a quick spreadsheet calculation on a $13 million deal. At a 7% reversion cap, keeping everything the same, the overall returns were 70%. But the minute I changed it to a 6% reversion cap, it changed to over 100% in returns. That's how powerful a reversion cap rate is. So you might seem like, oh, what's the big deal? They just went down by 0.5 point or 1 point. Dramatically changes the returns.
Yeah, I'm looking at a deal right now. If we're changing the exit rate by just 0.05%, 0.05%, we're moving the needle from 78% total return to 82% total return. It's crazy, the sensitivity of that thing.
Yeah, so that's why that exit cap, reversion cap number is so important, because if they're all the way down to the lowest number, like a 5 cap or a 4 cap in Mariel's example she just said, then there's no more wiggle room,
Yeah.
right? So
Yeah.
when you keep it high at like a 7% exit cap, which is very conservative, you got wiggle room for sponsor mistakes, things that go wrong, etc. And they can still come back with your returns because the market will take care of giving you a good exit cap of 6 or something. But yeah. Yes, Candace?
I had one thing to add. I don't know how
Yeah.
you do it, Sandhya, but one thing I'm careful of with reversion cap, I'll always compare that to market cap at the time of purchase, not to the purchase cap. And I see a lot of people doing that. As I say incorrectly, I don't really know what's correct, but if you overpay for a deal, or if the deal is just very poorly managed, and or maybe there's a huge value add component and you're buying the deal at a 3.5 cap, well, that doesn't mean you add 10 basis points a year and exit in 5 years at a 4 cap. You know, that's not accurate. So you have to be careful too, especially with those heavy value add deals or poorly managed deals, to always look at the market cap at the time of purchase, not the purchase cap.
Very good point.
Yeah.
Excellent point. Who else wants to add to that? Any other feedback and comments on what we've looked at so far?
I like what you talked about with location, Sandhya. Make sure that you find somebody who's not on the sponsorship team and who is very familiar with the area. I've had people reach out to me because I'm close to Memphis. I'm 40 minutes outside of Memphis. And there are deals. I know Memphis gets a terrible rap. There are deals to be had in Memphis, but it literally can change street by street. And I had this one person that was really trying to sell me on this one. And he was like, the second I saw the address, I said, nope, you don't want to be there. That is 100% a D area. And he's like, no. It's got, you know, the new Nike station's being built and the new FedEx. I said, I know where those are being built. And you can go 2 blocks in the other direction and be in a B area. Why would anybody like that? The jobs are not going to help your people that are living there. Like, you don't want to be there. And they still didn't believe me. And I said, I'm going to go drive down there and take video. And it wasn't until I walked the property and sent videos and I was like, do you really want to be here? And, but yeah, find somebody who's not on the team, because you can make it look on paper.
Yes.
Like, it's great. And it's literally 1 block away from being great. And you don't want to be there.
Yeah. And sometimes it's just the reverse. Like the other day I drove to a property and I was super surprised by the area, because I was used to the south of that street, and that property was north, and the north was awesome and the south was crappy. And so I was super surprised the other way around.
And so there are some brokers who keep circulating deals and have been sending Dallas deals to my friends all over. So everyone from Emma out in Utah to Christine in Florida, they've been calling me saying, is this deal any good, etc. And I just looked at that address and said, this is so familiar. I was like, okay, this deal was listed in the market several months ago. The call for offers was in October. They're probably under contract now, and it's in a horrible location. And it's only like less than 5 miles from my house, right in the middle of a very busy interchange, right by, you know, the corporate offices of Texas Instruments where I used to work, etc. But it's an awful side of the highway. Nobody buys there. I don't feel safe walking there, even during broad, daylight in the 10 in the morning. I wouldn't walk there. Why would anyone even invest in that property? It's very high crime there, etc. But if you didn't know all this, you would be like, what a fantastic location, right in the heart of Dallas, etc., etc. And it's like over $30 million. It's not like it's a cheap deal or anything. Like, no, you don't want to invest there. You'll get shot by the time you go to your property twice. You don't want to invest there. You want to have nothing to do with it. Yeah. So definitely ask your local friends. That's a huge source. And ask for references from passive investors and ask for a past track record. And after you've done all that and you like this sponsorship team, then you dig into these details that we talked about on the deal. I somehow thought this meeting ends at 9, so I was trying to rush through everything and get everything finished. When does this end?
To be honest, Sandhya, it's whenever you want it to end. We do try to keep it about an hour.
Okay.
But usually it goes to an hour and a half just because we chat and do Q&A, but it's totally up to you, to be honest.
Okay.
We're having so much fun. Let's keep going.
Yeah.
Yeah.
Start cracking open some wine.
Good company.
Yeah, I love just chatting in general. I love to hear everyone's perspective. But if we finish the main deal analysis questions, I would feel better if we stopped the recording.
Oh, yes. I didn't even think about the
Oh.
recording.
And then we can just chat.